Well, folks, we have some really bad news. The inflation report for September has come in a little bit hotter than most of Wall Street expected, which means that we are most definitely guaranteed a 75 basis point rate hike in the September 21st FOMC meeting, which is obviously causing a lot of stocks to tank in pre-market, specifically with the S&P 500 down almost 3% just in a matter of an hour, with the Nasdaq obviously leading the way down around 3%, which leads to the question whether or not this is actually the time to be a buyer and whether or not inflation can inflect within the next 6 months, or are we just all getting faked out? And those questions are exactly what we're going to address in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, I want to understand exactly what caused this inflation report to come in higher than expected at around 8.3%, because there's a lot of context we need to put into this report, even though on the surface it obviously looks very bad. If we cut straight to the chase, the main problem here is that excluding food and energy, the inflation gauge increased 0.6%, which is obviously higher than most people expected, which means that core PCE, which is what the Fed uses to judge their criteria, is actually rising a little bit hotter in August. As you can see, even though crude oil collapsed over the past 3 months, indices for shelter, Medicare, household furnishings, and vehicles actually went up in August, which means that either analysts got the inflation index completely wrong, or inflation is actually more stickier than we had initially thought. Now, I have no idea which one of those it is, but I can put out my theories for why inflation is coming in a little bit harder than expected. The first reason is that the food index has surprisingly increased 11.4% over the last year, which means that right now this is the biggest component that is pushing up CPI. Now, this is good because food typically tends to be very volatile, but apart from rents, this is probably one of the biggest indicators of where inflation is going to go over the next 12 months. Now, this massive rise in food prices could be attributed to the very strong dollar, which is obviously weakening other currencies and as a result making exports and imports more expensive across different nations in the world. But there's another reason why inflation could be going higher, which is a topic called inertial inflation. You see, when interest rates are raised initially, there tends to be a little bit of price hiking that tends to happen in most assets, specifically in the rental space, where all of a sudden folks that cannot afford a mortgage are gonna go and rent new houses, and obviously that tends to push up the prices of rents, which again will increase the CPI. Now, the real problem with this is that we have no idea how long this inertial inflation period will last, but it looks like that is exactly what we're going through right now, because a big reason for the hot report was shelter prices. And although mortgage rates have gone up and all of a sudden prices of real estate are going down, people are still paying a lot of rent, which again will translate into higher good costs. It's evidently clear that the real estate market has pivoted to the downside, with around 20% of homes only increasing their value in July of 2022, and around 45% mostly flat, with around a 35% decrease in most prices. Now, obviously, real estate operates with a lag, which means that at least it's going to take 6 months for this real estate drama to get priced into CPI, which means that 2023 could look a lot better than we're experiencing right now. But again, in the short term at least, inflation is a little bit more of a problem. And with the August readings priced in, core PCE is still increasing year over year from 6.2 to 6.3%. Meanwhile, obviously, core CPI has actually fell a little bit because of the change in oil prices. And historically, if you look at the trends, when PCE tends to go down, which is the orange line, core CPI also tends to follow down, which is obviously the blue line. But right now, at least, we're seeing some sort of sideways action, which hints to the Fed that they need to be potentially a little bit more aggressive or wait out a longer period before pivoting. And so the bottom line is that even though the core PCE being lower than the CPI is a good sign for the Fed, it doesn't necessarily mean we have hit the exact peak. We could still see a lot of fluctuations up and down around this region until we start seeing a pivot in real estate and obviously consumer demand. But the good thing is that if you actually look at the CPI breakdown, over 90% of the CPI is related to oil prices in all these categories in the top 6, which means that overall, as oil prices come down, that'll start bringing down the inflation report year over year for these specific categories. Now, obviously, the middle ones have been the main ones causing the problems, which include vehicles and food. But again, that could be driven by higher rent prices because of the inertial inflation that we might be experiencing as mortgage rates skyrocket. And I don't know about you, but summer typically tends to be a lot more of a spendy period for me because obviously I tend to go out and vacation a lot more, which could be a similar trend we're experiencing this summer because obviously this summer we saw a lot of people catch up on the events and the experiences that they missed out on for the past 2 years, which again could be driving inflation higher in the short term. And unfortunately, wage growth is still pretty high year over year, which means that we could still see a lot more spending and potentially an even stickier inflation report unless we start seeing more layoffs in the industry. And so the bottom line here is that even though inflation month over month is flatlining, which is a good sign for the Fed, in the short term for the next 4 months, we could be headed in a more volatile period, potentially to the downside in the stock market, because obviously inflation is not showing signs of going down. As for me, am I planning to sell any of my stocks based on this inflation reading? Absolutely not. I don't let any short-term macroeconomics really affect my thesis on these companies because the fundamentals have continued to improve. And the only reason these stocks are going down is because as interest rates tend to go up, it reduces the future valuation of these unprofitable companies, which obviously means that in the short term, they could be valued less by Wall Street. But again, as a long-term investor, these interest rates will have a very minimal effect on companies that are well capitalized. But what I would really say is that if you're a short-term trader instead of a long-term investor, then you want to really pay attention to what the CPI report does because there's a lot of catalysts coming up going into the end of the year where the Fed might be raising more rates and obviously conducting a lot more propaganda because of the midterm election season. But the good thing is that if you look at the S&P 500 from a technical aspect, we did end up making this higher low and this higher high compared to these previous highs that we made in May and June of this year, which means that potentially we're starting an uptrend from a technical standpoint. And if you're focusing more on the small cap growth stocks, the real index you want to pay attention to here is the IWM Russell 2000, which right now is also forming that higher high and higher low, which could be signaling the near-term bottom already in place. And because of the fact that most retail investors on Twitter and social media are still so bearish on this market, I tend to get more comfort from that buying in this kind of environment because I know the edge is in my favor. When most folks are on one side of the trade, it becomes a lot easier to profit from the other side of the trade, which is kind of what we saw in this rally that happened in July and August, where absolutely no one expected it. And when we did end up getting that expected pullback, everybody was cheering and expecting the market to hit all-time lows. And funnily enough, that same thing has happened over the past week or so when we saw this rally, where most folks are in disbelief that the market can go any higher. And it's really during times like these when 49% of all millennials have sold out of their investments over the past 12 months that makes me very confident in buying the dip because obviously this is the dumb money and these guys are often selling into the smart money. And although this doesn't mean that the market's going to bottom next week, it does show us that overall in the medium term time frame, you're getting a good buy the dip opportunity if you're buying good businesses that you have good conviction in and that are well capitalized with a long-term bull thesis. Institutional traders, as a matter of fact, are still very much net negative on the market, which means that volatility for the next 6 months will be higher. But again, as a longer-term investor, it means you're getting good opportunities because a lot of these hedges are already getting priced into the market. And this is a good sign that the prices of your stocks could be approaching the bottom when most institutions and hedge funds have already sold out of their positions. And last but not least, I think it's also important to mention that the month-over-month inflation report, which is something many folks tend to overlook, is actually looking a lot better than it has over the past 6 months, which is giving us a sign for the favor in the long-term investor. And although the headline year-over-year number, which compares 2021, is still high, the month-over-month trend is actually shifting to the downside, as can be seen by the blue and the yellow bars, which show the core and the headline. This doesn't mean that the Fed is going to ease off the brakes anytime soon, but it does mean we could be seeing a peak when it comes to interest rate hikes within the next 6 to 12 months, because obviously rate hikes work with a lag when it comes to taming inflation. But as usual guys, make sure to drop me a thumbs up if you found some value from this video and let me know down in the comment section below what you guys think of this inflation report and whether or not you're selling stocks in this kind of environment.